How do open market operations strategies change? Imagine a central bank like the Federal Reserve playing a game of balancing a scale. The goal is to keep the economy steady by controlling how much money is in circulation. This game has evolved a lot over time, with strategies shifting as economic conditions and policies change. In the early 20th century, the Federal Reserve learned that buying government securities on the open market increased bank reserves, making it easier for banks to lend money. Selling securities had the opposite effect, reducing reserves. This understanding turned the Federal Reserve into an active player in managing the economy. At first, each reserve bank made its own decisions, but over time, the Federal Open Market Committee was created to coordinate these actions and set policy directions. During the Great Depression, the Federal Reserve changed its focus. It moved from using bankers' acceptances to mainly buying and selling government securities. This shift helped stabilize banks and support economic recovery by increasing reserves when needed. Over the following decades, the main goal of open market operations was to influence short-term interest rates, especially the federal funds rate, which is the rate banks charge each other for overnight loans. Before the financial crisis in 2008, the Federal Reserve used open market operations mainly to keep the federal funds rate close to its target. But after the crisis, the strategy changed dramatically. The Fed started buying large amounts of longer-term securities, a process called quantitative easing. This helped lower long-term interest rates, encouraging borrowing and spending to boost the economy. As the economy recovered, the Federal Reserve began to reduce its holdings of securities gradually. It also started using tools like overnight, reverse repurchase agreements to help keep short-term interest rates within the desired range. These operations are like fine-tuning the economy's engine, making sure everything runs smoothly. Overall, open market operations have shifted from small, decentralized efforts focused on short-term liquidity to large-scale, coordinated actions that influence a broad range of interest rates and economic goals. These changes reflected how central banks adapt their strategies to meet new economic challenges and keep the financial system stable.